What's going on, everybody? Welcome into another live. I'm going to give a couple of seconds for people to jump on. If you're listening on Facebook, on LinkedIn, on YouTube, thank you guys for joining me again today. Guys, today's going to be an important one. It's not always an important one. I'm going to be quite honest with you. Sometimes we're just talking about the next cool listing. This one is going to be actually an important one because there's a lot of confusion and a lot of talk out there about the big, beautiful bill. What does it include? What does it not include? How does it benefit me? How do I get those benefits? Are they automatic? What needs to happen with the big, beautiful bill? And here's the thing, guys. And I learned this actually early on in my real estate career, and I was shocked by it. Now I'm not so much, but back then I was really shocked by it in terms that most of us don't really know how this real estate thing works. And when we hear politicians talk about tax cuts, tax breaks, things like that, deductions, credits, we don't know what that means. I didn't know what that meant at all. So we hear tax cuts and we automatically think, okay, great, I'm going to pay less in taxes. But it doesn't automatically work that way. So we need to understand, what are the deductions? How do they work? Who are they for? Are they capped? Are they not capped? All of that information becomes incredibly important when powerful legislation like this or overarching legislation like this gets passed. So today I want to talk about 3 specific points of the big, beautiful bill that every single homeowner, aspiring homeowner, definitely needs to be aware of so that you can buy into and understand these credits and benefits. Because what is true is, so often there are benefits on the table and people don't take advantage of them, either because they don't know how, they're not told, they don't understand how it works. And so we want to try to fix a little bit of that here today on the show. So once again, thank you guys so much for joining me. Let's jump right into it. So we have 3 key changes in the big, beautiful bill that could affect housing. I'm going to talk about each one specifically. We have, first of all, the mortgage insurance premium deduction. Okay. The mortgage insurance premium deduction, this is something that was a thing back in 2021. It phased out and now it is back. Now it is a thing again. So first off, what has changed? What has changed? So mortgage insurance premiums are officially deductible again. So this means that if you're somebody that is paying PMI, which basically anybody, with the exception of a few maybe private conventional programs or whatever the case may be, most people that give less than 20% as a down payment are going to be paying mortgage insurance. So if you're paying PMI or any kind of mortgage insurance, you're going to want to stick around for this. So here's the scoop, basically. They're officially deductible again. Now, who gets to use these? Who gets to use these? These are for people that are itemizing their deductions. So they're not just taking the standard deduction. It's people that are itemizing. They can now get the mortgage insurance premium deduction. Now, when I talk about the itemizing and the standard deductions, this was something that I didn't understand in the past either. And here's something where when we hear, oh, they're going to cut my taxes, great, that's awesome. But then we take the standard deduction because nobody told us the difference or nobody walked us through how this was supposed to work. Then you completely miss out on what could be a larger benefit. So if you're itemizing your deductions, so you're not just taking the standard deductions, you can claim this. And again, usually if you put less than 20% down on your house, you're stuck with that mortgage insurance for a while. Most FHA products are going to have them for the life of the loan, with some exceptions. Conventional, you're going to have them in most cases until you have at least 20% equity. So that can be years before that actually happens. And so you're going to be stuck with that mortgage insurance for a while. And this applies whether you just bought your place or you've had a mortgage on it for a bit. There are people that bought their house 10 years ago, and because they did FHA, they still have that mortgage insurance on it. So if you are somebody that is itemizing, or even if you haven't itemized in the past, you might want to look into talking to your tax professional to start itemizing some of these deductions so that you can actually benefit from them and seeing what makes more sense for you. I'm not a tax person, but I've seen many cases where once you start to stack these tax deductions, you get a bigger benefit than if you just took the standard, okay? Now, the thing with the standard is that it's easier because you don't have to think about it. You don't have to organize anything. It's just I take the standard and I'm on my way. But there could be major benefits to itemizing, and I highly recommend that you talk to your tax advisor to see if itemizing makes any sense for you. Okay, now, are there any limits? This is another key question. Are there any limits? So in this case, there is an income cap. So if you make over $100,000 a year, the deduction starts to phase out. And if you're way above that, it might disappear completely. So remember, the key with a lot of these tax deductions is to help the working class, is to help the middle class. And this is their way of doing that, whether you agree with it or you don't. The bill has passed, it has been signed into law. So it is now a thing. And because it is now a thing, we need to understand it. So again, there is an income cap. If you make over $100,000, the deduction phases out. And if you're way above that, then it might disappear completely. So definitely check where you land on that based on your income level. And here's where I do want to make an important caveat that I think a lot of people miss. You want to have a good accountant. You really do. You want to have a good accountant, an accountant that doesn't just do the bare minimum, but somebody that is going to explain these things to you. Somebody that is going to explain these things to you in depth, analyze the situation, and instead of just asking you, hey, so what do you want to do? And then doing it, that actually gives you a strategy. Now, that might be more expensive. It might be more expensive to get that caliber of a tax professional in your corner, but it is absolutely worth paying for, because otherwise, a lot of this stuff is never going to move the needle for you, because you're either not going to understand it or you're not going to plug into it and take advantage of it when you could. So that's a little bit about the limits. Now let's talk about how much you can actually deduct, because it's like, is it a percentage of my MIP? Is it the whole thing? Is it the whole premium? How does that work? So how much can you actually deduct? It's the total mortgage insurance you paid for the entire year. So for most people, that could be anywhere from a few $100 to a few $1,000, especially if you have, I've seen a lot of people that are paying $250, $300 a month in mortgage insurance. So a lot of that depends on your loan. It depends on your credit score. So for example, if you're on a $300,000 mortgage, you might be paying anywhere between $600 to $6,000 a year in PMI. And for most people, it's going to be leaning towards the thousands of dollars. I don't see a lot of mortgage insurance premiums that are below $100 a month. So if you're paying $200 a month in mortgage insurance premiums, that's going to be $2,400 in a year that you can now deduct. And all of that could be deductible from your tax burden. Now, here's the best part. This isn't a temporary thing anymore. Remember, this was a thing back in 2021. They got rid of it. Now it's back. So it's not a temporary thing anymore. It's permanent. So you can plan on this deduction sticking around for the long haul. This is something that is going to be there every year as you pay your mortgage insurance, with every payment, that's going to add up to massive deductions at the end of the year that you can have the benefit of. Now, here's the thing. Why should you care? Why should you care? Who cares? It's mortgage insurance. Who cares? I don't even know how much I pay. It doesn't matter. If you're paying mortgage insurance, you might as well get the benefit from it, okay? Because mortgage insurance isn't necessarily there to protect you. It's there to protect the lender. So if you're paying this mortgage insurance, this could be the thing that finally makes itemizing these deductions worth it. It could finally be the thing that pushes you over to actually doing the work, to itemizing the deductions, learning about it, getting educated about it so that you can reap the benefits of some of these changes that often come through legislation. So this is a legit way to lower your tax bill, my friends. It really, really is, especially if you're a middle-class homeowner. Now, here are a couple of quick tips when it comes to the mortgage insurance deduction. You want to hang on to all of your MIP records, all of them. Now, this is relatively easy to get. Usually it's going to be itemized in your mortgage statement. Every month, it's usually going to be the same amount. So at the end of the year, you should have all of that documentation as to how much you paid in mortgage insurance premiums throughout the year. Now, if you're close to that income limit, that $100,000 income limit, you want to talk to a tax pro to see what makes sense for you. So again, it goes back to this point of having a competent tax pro in your corner that can help you navigate all of these things. So that's number one. Okay, the mortgage insurance deduction, huge for those that decide to take advantage of it. The next one is this one, the low-income housing provision. So the low-income housing provision is supposed to lead to more rental properties. So let's talk about that one, because when you look at something like this, low-income housing tax credit, great, it sounds great. What does it actually mean? So first off, there's this thing called the low-income housing tax credit. Basically, it's a way for builders to get a tax break if they either create or fix up rental housing for people that don't have really high incomes. So get this, David Dworkin, if you don't know who David Dworkin, which you probably don't know who David Dworkin is, Google him. He's the president of the National Housing Conference, said that these changes could help either build or save over 1 million affordable rental homes between 2026 and 2035. 1 million units. 1 million units. That's a lot of units. That's a lot of families. That's a lot of people that are going to be able to have a place to live without breaking the bank. It's absolutely massive, right? So with that, you also dive into opportunity zones, which is another part of the bill, which makes opportunity zones permanent. If you haven't heard of those, there are these special areas. Basically, there's like pockets in the city where investors get tax breaks for building stuff, whether it's like apartments or businesses in neighborhoods that could use a boost. So every area, if you go on Google and you say, for example, in my case, Provo, Utah opportunity zones, there are these maps where it shows opportunity zones. And if somebody builds in the opportunity zone, then they get those tax breaks. So instead of those going away, now those opportunity zones are going to be here to stay. And the idea is to get more developers interested in building in these areas so that they don't just become these just way out in the boonies areas that nobody cares about. It's a way to incentivize investment to revitalize certain neighborhoods because these builders and developers know that they're going to get tax breaks if they build in those areas, which hopefully this means more rental options and maybe even some new jobs and businesses in areas that might otherwise be largely ignored. So when you look at whether it's the low-income housing credit or the opportunity zones, the question might be, okay, why does it matter right now? Why does it matter right now? And let's be real, guys. And I've talked about this on the show ad nauseum, but it's really difficult for a lot of folks to buy real estate right now. It just is what it is. I mean, buying a home is out of reach for a lot of people because of prices, because of interest rates, because of, stagnant wages. There are all these things that are kind of stacking and making people play on hard mode. There's all these things that are happening that are making people play on hard mode because of how expensive everything is. Not only that, but there's still, even though there's a lot of new listings on the market, there's still just not enough houses to go around. There's just not. And there's all this pent-up demand of people that need housing but can't afford it. So making it easier to build affordable renting is a massive deal, especially in these opportunity zones. It is a big, big deal. So wrapping up, to sum it up, you've got more tax credits for builders, which should bring more affordable renters. You've got these opportunity zones. Again, check in your area what the opportunity zone is. Those are sticking around. So if you have a lot of opportunity zones in your area, you can expect more development in those areas so that they don't deteriorate. There's an influx of money to those areas because builders and developers have that incentive to do so. And again, all of this is supposed to help people who are struggling to find a decent place to live. We have to solve this housing crisis somehow. And some people are going to be able to buy. Some people are going to need to rent. And that is okay. That is absolutely okay. But we need to understand and build and cater to everybody. It doesn't matter where they are on the income spectrum. We need to plan and build and give incentives for everybody. So this is actually a huge one that I really hope will have positive impact when it comes to solving the housing crisis. So that's going to be number 2. And number 3 is the SALT deductions. Now, the thing about SALT deductions is, again, it's one of those acronyms that nobody knows what it means. A SALT deduction. It's okay, well, I put salt on my food. What the heck does that have to do with getting a deduction? Do I have to track how much salt I'm putting on my stuff? What the heck is a SALT deduction? So let's start there because I didn't know what it meant. in the past. Now I do. But SALT, S-A-L-T, it's an acronym. It stands for state and local taxes. That's what SALT stands for. SALT stands for state and local taxes. So basically, here's how it works. And this is going to be the nerdy, boring part, but it's important. When you do your federal taxes, you can deduct what you pay to your state and local government in things like property tax and either your state income tax or sales tax. It's a way to lower your taxable income on the federal level, which is always nice. But here's the deal. A few years ago, they put a cap on this deduction. It was limited. So since 2018, you could only deduct up to $10,000 a year. So you would take what you paid to the state or to your municipality, and you could deduct that up to $10,000. And not only was it only $10,000, but it was $10,000 if you were married and filing separately. If you were just single, then it was just $5,000. Here's where it starts to get confusing. You're like, okay, 10,000, 5,000 married, joint. I have no idea what this means. I don't even care anymore. So $10,000 if you're married and filing separately. Now, before that, there was no limit. So people in high tax states like New York, California, New Jersey, they could deduct a lot more because there was no cap. So here's the update. Starting next year, thanks to this new law, the SALT cap is jumping up to $40,000. The SALT cap is going up to $40,000. So from $10,000 a year to $40,000 a year, you can deduct your state and local taxes to reduce your federal bill when it comes to doing your taxes. So massive, 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 massive. Now, it is a big change, but this one is only for a few years. The opportunity zones, the mortgage insurance, those are supposed to be permanent, but the SALT cap is something that is temporary. It'll go up a bit each year through 2029, and then it drops back down to $10,000 in 2030. So the goal is to, from now until 2030, to give people another tax deduction to lower their taxes for a short period of time. So again, you need a good tax professional that can help you navigate all of this for your specific case. I'm not a tax pro, but you got to find one. And there's one more thing. If you make more than $500,000 together, or $250 if you file separate, your deduction starts to phase out. But you can still deduct at least the original $10,000. So if you're high income, this doesn't necessarily apply to you. You don't get that jump up. You still have the $10,000. So all of that, here's what all of this means for you. Number one, if you live somewhere with high taxes, you live in a state that has high taxes, and you usually pay a ton in state and local taxes, you might actually get a bigger deduction for the next few years. If you're in an expensive state, you can get a higher deduction for the next few years. But again, you only get this if you itemize those deductions. If you just take the standard, the SALT cap doesn't apply to you. It doesn't matter. So here's one more benefit, if you will, to actually itemizing and getting your taxes in order. For a lot of people, especially if you don't pay a ton in taxes or you take the standard deduction, this one doesn't really matter too much for you. If you live in a very low tax state, or you take the standard, then this isn't going to make a difference. But the point is, and the reason why I break it down in these lives, is because there are so many people that could benefit from these tax deductions. They either don't know that they exist, they don't understand them properly, and nobody ever takes the time to run them through that and see, okay, could this be a benefit for you? Could this not be a benefit for you? Which points to often this sentiment that we hear on the news, oh, taxes are going to go down. Whatever politician it is, and I'm not just talking about President Trump, any politician, most politicians push tax cuts. And then they win, and then our tax burden doesn't change, and you're like, well, I guess they lied to me. I guess it was all BS because my taxes didn't actually go down. Well, sometimes the problem is that you didn't do this part. You didn't actually learn or understand what they meant by tax break. Like, what does a tax break mean? How does it work? And the tax code is so incredibly complex that the average individual just has no clue. So if you're one of those people that you're not sure whether you should itemize or just take the standard deduction, it's absolutely worth running the numbers and talking to a tax pro. You have to do it, my friends, because this is how you play the game. This is how you know what makes sense and doesn't make sense for you, what applies for you, what doesn't apply for you. And depending on where you live, depending on your income level, depending on a number of things, that will determine if it makes sense or if it doesn't. But that's what I want to get at. That's what I want to get at. Because we see these headlines and then we don't receive the benefit for it. So in recap, we have our three that we talked about today. We've got the mortgage insurance deduction, okay, which now you can deduct the entire amount of mortgage insurance premiums that you pay throughout the year. So you got to make sure that you track all that you keep your mortgage statements, all of that stuff, so that come tax time, you can collect that data and know how much you paid. And again, most people, especially if you don't have perfect credit and you brought a low down payment, you're paying $250, $300 a month in MIP. So that can be $3,600, $4,000 in deductions that you can absolutely receive. That's number one. Number two, we've got the low income housing provision. This is supposed to lead to more rental properties. This talks about opportunity zones, certain areas where we want to get builders in there to revitalize the neighborhoods, have more affordable housing, things like that can also be beneficial. And then, as we just talked about, the SALT deduction, which means state and local taxes. So very boring, my friends. I get it, super boring, but these are the things that make a difference. These are the things that we need to be aware of. And if there are any agents out there that are listening, you damn well better understand these things. Even if you're not a CPA, that's fine. That's okay. No problem. But you should be a real estate advisor. And as a real estate advisor, you should be able to at least open up the conversation as to how owning real estate can impact people when it comes to their tax burdens. Be able to be dangerous in that zone to at least start that conversation, always pointing them to the appropriate professionals. But residential real estate has massive benefits to those that understand it. And that's how the game is played at the highest levels. When you look at, and when people say, oh, it's because the rich never pay taxes or the wealthy never pay taxes, first of all, debatable statistic, number one. But number two, why is that? It's because of this stuff. It's because they understand, or they pay people to help them understand what all of these deductions are to lower their taxable income as low as it can possibly go. But if we only believe that that is a game that the wealthy can play, then we miss out on a lot of opportunity. We truly do. And I've seen it time and time again. But if you are, whatever it is, if you're making $45,000 a year and you bought a condo, there are benefits for you. There are very real benefits for you. But if you don't know what they are, you don't understand them, nobody explains them to you, then you're never going to get very far. So that's all I got today, guys. Hope that was helpful. Share this, pass it on, subscribe to the channel. Wherever you're watching, like, comment, all the stuff. And we'll see you guys next time.